Computer. Pause. All right, good morning, guys. This is Foundation's Q&A check-in for May 14th, 2023. We'll just jump right into it. So Rad asked, how do we treat the long game, so to speak? And the proper trade histograms should look like between -1 and +2 and 2-hour wins, and 2-hour wins capped at 2 hours gifts. I'm a bit confused. I thought the whole idea of the game is to minimize losses and let the winners run, meaning that the long game is to stay in the game long enough to keep tracking winners well beyond 2 hour to really build the account and to get the most of what you can. After the histogram discussion, it seems like 2 hour is supposed to be the leading building block of the account, and with a proper win-loss and reward to risk ratio positive expectancy can sort of clarify that. Is the 2 hour the way of staying low and feeding off 10 hours? So just as a matter of quick review, what I look for in the histogram is three things. So between -1 and +2. So the very first thing that I look for is no losses greater than -1. And what that means is that we are capable of identifying a manageable risk and then setting up a trade frame that allows us to manage to that risk, excuse me, in order to base our future projections. And if you can do that for 30, 50, 100 times and not take any losses greater than -1, we're entitled to say that so far we seem to be developing the skill to not take unmanageable losses. So that's the first thing. The second thing I look at is in the space between -1 and +2. What I'm looking for in this region is, a histogram that looks something like normal, and it has something like 85%. 85% of the trades I would expect to be between -1 and +2. And the reason for that is that, especially on the day trades, I'm looking for, here's my opening or whatever, and it sells off to a low of the day. And so I'm thinking, okay, SSC, because that thing came down by a fail stat, was at this level. Oh, it made a nice orderly move, in the first 10 to 30 minutes, and is now starting to, it feels like it has put the bottom in. That is always enough to constitute a harsh winter, because that's how much it fails on average, and winter is an average season. So if it falls a normal distance from the open to what is currently the low of the day and then starts to reverse, then all winters feel harsh when you're in them. And then if I were to look down at the MACD, and especially if yesterday closed here, and then that created the gap, and it opened here, this actually counts as part of the MACD histogram calculator. So you would see that thing in a gap down and a normal fail stat move early within 10 to 30 minutes. That is mathematically, it must produce a harsh winter. It must. And it's going to leave the Red River behind. That's everything that I want to see. So later on, when say, hey, finding the movers, that's part of it. is look for that pattern. Well, which ones have the biggest gaps and have sold off to a fail stat? Could you have that in TC2000? Yeah. As little criteria. Hey, it gapped down. Check. It sold off to a fail stat. Check. Winter turned to spring. Check. Or crossed the RLXD. Check. And now, if you had a whole bunch of symbols that you had prepared, you could rank this by, even percent sell-off. And the ones that hit those three criteria, you found the movers. Well, if this is sort of what I'm looking for, anytime this happens during the day, I know where the low of the day is. And I know what a plus range stat price level is off the low of the day. So I know that is a maximum reasonable intraday move. That means I can use that to judge whether or not I have a 2-to-1 reward to risk ratio at any time during the day based on whatever little pattern happens to be setting up. So right here, I'm looking at something like winter has turned to spring. And maybe it's entered the Red River or something like that. I'm going to draw that so you can see it a little easier. Maybe it's come into the Red River, and there's still some room in the spring before it goes to the summer. Because this is where the summer's going to be until it goes into the fall. And then I hope that it's going to go right back into the summer again, because that's going to be amazing. But if it doesn't, it's going to come down here, and it may recover from there back into the summer, and that's good. But if it doesn't, it's going to go into the winter, and that's great. So each one of those little 7 checkpoints on the MACD histogram is a way to anticipate a mover getting ready to happen. Why is it? Well, I'm always ready for it to collapse right from the opening if there was a gap down. That's the least surprising move of all, would be a move to a fail stat. That's tradable. How could I trade that? Well, I could have the open right there, and I could put my little MMRB, one on either side of it. And if price comes out of it, I just found the mover. And where could it move to? It could move to a fail stat, which is a normal move from the open down to what turned out on average to be the low of the day. So that's a normal move. And if that happens fast, within the first 30 minutes, then I just found sort of like the maximum expectable normal move, if I could say it that way, from the open. So the gap tells me how to find the movers. Where does that get found on the TC2000 or any? By sorting by percent lost so far today. Because that measures from yesterday's close to the open, and it's already down 2%. And if I sorted by percent loss, the ones with the biggest gaps go right to the top. I could even have a column in TC2000 that reminded me of which ones had the biggest gaps that day, so that as price starts moving around and you resort it, I could always come up with the list, or take the top 5 gappers and just put them on a list and say, hey, this list of U.S. steel and oil and whatever, those are the big gap losers today, so fine. Or the gap winners, because it's the absolute value of the gap. So what you got to do is, if you sort it by that, you've got to find, maybe the top 5, and then I say the bottom 5 because I'd like to go for the ones that have the minus percentage so far. So these are the biggest adverse gaps. Those are the biggest favorable gaps. A big favorable gap predicts a big move that day anyway, in the same way that a big down gap predicts that move. So there's how you find the top 10 most likely to have a big follow through, the percent gap. That's how you find the movers intraday. And then you could set up these other criteria to decide what you're going to do. So if that's the general framework of what I'm trying to do all day, right from the opening, I'm looking for big gaps down, which ones sold off to a fail stat, and then went from winter to spring in the MACD, because that is now coming into my wheelhouse for setting up my MMRB, which is for me the R10. Now, how many north of that do I have to the plus range stat? How many of those?
9.
9. So if I set, I think of those 9 as 3 groups of 3. And if this is going to be an A trade, it's going to go to the range stat and beyond. If it's a B trade, it might go past that first group into this region. And if it's just a crap move, it's going to be that. So I think of that as leg 1, leg 2, leg 3. Check or hold?
Yeah.
So if my average win, let me put it this way, my average win is probably somewhere around here. And that's because the darn thing probably moved this far and came back, and then I took the exit here. But I had a bunch of ones that did this. No lose plus dinner for 2. I had some that did this or this. So we'll remember that the definition of that is the total, is the average range from the high of the day to the low of the day, average plus 1 standard deviation. That means 85% of the time in the last 30 days, it did not get higher than this. And it normally takes 3 legs for that to happen, to get above that. It was a day that just went like it maybe gapped up and then just did that and never looked back. It never even wiggled enough for me to have to do an exit and then a COTA 2. All it did was just go. You know how many times that happens? Not much, but enough that it could happen, which is why I like to get started early. So most of the time, if it gets past that range stat, it's going to go through a series of these little oscillations, and I got to get my little COTA 2 game for re-entries ready to go, because every little time it does enough to get me out, I have to be ready to get right back in. So if I end up getting 10R from that, it's, unless it went right to the roof, I'm getting pieces of it all along the way, and those tend to be 1.5 and 0.7 and 2.2 and minus 0.5, and so I'm collecting all these little tokens on the way up. The series for the day might be 8, which is like a massively good, R multiple, but it was collected by a series of little lottery tickets and tokens collected all along the way in the usual spot. So if I'm searching for 2 to 1 and I get 2 to 1, what that means is I probably got something like this move in the C range. An average day at school. And what it probably did was, there's my little 3 pieces of initial MMRB. It probably went up almost to 3 and came back. And I got the exit right here. And then I collected 1, 2 against my reward to risk. So I got my 2R win. That is all I ever hoped to get out of that whole process of going up to a range stat kind of day. Is I see that as a series of these little chunks where I'm aiming for 2 and I stumbled into getting 2, but I don't want it to be less than 1 or something like that. So what that means is when you have that mentality, I say all of that simply to say that that's why I expect 85% of my trades in my histogram to be between -1 and +2, because I'm looking for that little series of steps up the ladder, and it comes in those size steps. So the third thing that I'm hoping to see in the histogram, so if the first one was no losses greater than -1, the second thing is a normal looking curve between -1 and +2. Which is positive expectancy. Because that means that my normal trading with normal results in the way the market normally works is allowing me to earn a professional living, because I've taken care of the weak sauce and I have a professional process in here between -1 and +2 that is earning me money. The third thing that I'm looking for is the region beyond +2. And I would like to see trades out here beyond +2. And what that means is that I am aware and I'm attuned to the fact that sometimes these things will go beyond my 2R limit because it's just going to do what it wants to do. It took that little entry and never looked back. And it's going to go to the range stat and beyond or whatever with very little oscillation. So it's got this powerful rocket ship that has blasted off. It has blasted off for some reason, and then that little move up in here has these little tiny oscillations that never get me out, and up I go, and I'm getting, on occasion, wins bigger than 2R, and what I'm doing is being very judicious to make sure that I lock in those gifts so that I don't let a great trade come all the way back to 0. So if that happens, then I would expect maybe 15% of the time I would expect something like 15% of the time to see trades better than 2R. So the first thing I look at is no losses greater than -1. Second thing, positive expectancy and a normal looking distribution with most of my trades between -1 and +2. And then 3, fat right tail, meaning that I am accepting gifts. Here's a tip jar market. Just drop a tip in there. Now, Rad's question was, why are you capping the 2R as gifts? Only for calculating system quality number. What I want to do is, I'm going to collect those R's, but for calculating system quality number, if I just make that a 2R win, and then throw that into the mix, when I'm computing SQN, what I'm doing is really just looking at the reliable, normal, professional side. I'm not looking at these anomalies. Because if you're not careful, the outliers make you think that they are normal, and that's the opposite of the definition of an outlier. So all I do is take the professional collection for that trade, and then I use that to calculate the SQN. Now, when I am concerned about minimizing losses and letting the winners run, the way I look at that is, what is my average loss versus my average win? And if my average win is bigger than my average loss, I accept that as my professional definition in this system of letting the winners run. And if I have the histogram that looks like I've cut my losses, I am positive expectancy on my boring trades, and I'm open to the possibility of a fat right tail, I also have big fat winners on occasion and never big fat losers. That's another so I have two definitions of how I define letting the winners run. My average wins versus losses, that's coming from this region, and then fat right tail on the right side and no fat right tail on the left side. I am cutting the losers, I'm letting the winners run, and then I'm only getting that 15% of the time, but that's because of the way prices move. I'm looking to get normal moves, and I will accept abnormal moves on the plus side, but none on the losing side. Now, if you read Michael Covell, who has written the definitive book on trend following, what he says is, get you a great big fat risk box and 15, 20, 30, 50% risk, and then buy a thing that you think is going to trend, and then just leave it alone with a great big fat trailing stop. And then what you're going to get is these fat right tails that pay for everything that wasn't a fat right tail. Not my style of trading. Not my style of trading at all. If you did that, you'd take a ton of -1Rs. You'd take a ton of those. And you would have some very, very small number of ones that were 15, 20, 30R wins. If that's the way you want to trade, read Michael Covell's book, and he creates the justification for that. I like getting tapped into those big trades. But the way I do it is I'm getting all of these little chunks and re-entries and careful attention to detail in a professional way. Michael Covell wants to set them and forget them and go away. And that's That's fine. That can work. Don't confuse those two very different styles of trading and then try to understand them as if minimizing losses and letting winners run means exactly the same thing. 90% of the people that read Covell's book and are trying to adopt this mentality are thinking about that little thing, wide stop, let the super huge winners pay for everything else. I'm not doing that, but I'm still taking that guidance to heart. Check or hold. That's what I'm trying to say. Are there ways in your toolkit to find things that are getting ready to move? Yes. One of them is exactly what I showed you for the day trading, and that was that big fat gap. And then looking at the... Oh, I wish I hadn't erased that. Darn it. I'll draw it again. Oh. And I just knocked the pen out. There we go. Let's see. Spring, summer, fall, So, right from the opening, I showed you what I meant about the big gap. That's a way to find the mover. When you see them bottom out and winter turns to spring, but before it gets to the Red River, you have a chance to stalk that, because if it enters, crosses, leaves the Red River, and still has some room before it gets into the summer, there's an opportunity for an entry into a mover in the spring that successfully got past the winter, right? But this is also a time to stop. Hey, what if it goes here and fails? That's going to be a massively big sell-off. So the fact that it paused and went briefly into the spring, and this is on any time frame, this is an alert, that's an alert. When it leaves the Red River, that's an alert that it could be moving up strong. When it goes into the summer, that thing is moving. You found it. Well done. Same thing at this end. When it starts to stall, you wonder, now I'm stalking. When it goes into the fall and starts to recover, you say, oh, if that goes into the summer, I'm so long on that because it's going to be a COTA 2 and I just found the mover. But if it doesn't and it gets to the zero line, I can say, well, what if it goes into the summer now? It had a nice move, it pulled back to support, and now it's resuming. That's also a COTA 2, but it's not as strong as the first one, because the first one, the buyers came in right away. But if it halts right at the zero line, now you've got a mover that's going into the winter, or it's going to recover and go into the spring off of support. So you just found a potential mover. And then if you see winter, spring, winter, look out below, that thing is collapsing. So you can use the MACD histogram for that. Other ways that you can do it. When I go through the weekend report, and this also answers one of the other questions, how do I find the trades to frame for tomorrow? There is 2 15-minute or less videos on Tortoise Capital .net. It's also somewhere in the Foundations course. But if you just go to tortoisecapital.net and go down to the, where's the freebie? I just had it up. What, dummy? Oh, there it is. Okay. So free background material. This one gets you to time frames, and it's going to answer. Brian's had a question on. He's only got 2 hours a day, and where should he trade it? I break the market into 15 segments, 15 30-minute segments. The first 30 minutes are just absolute crazy maniac volatility. And the last 30 minutes, everybody is unwinding their positions because they have to unleverage. So you get crazy moves, big, strong, fast, hard moves in both directions that are different than what happens in the middle of the day. So what happens in the middle of the day is sort of like normal behavior. And what happens over here is crazy madness. Now, I like this on the front end because I can get started right away with a hybrid frog, and I have all day to be able to participate in a range stat move, maybe up, that just did that and started in that first 30 minutes. And I know how to exit and manage my risk. That's fine. And I got all day with leverage to handle that. But the last 30 minutes, whatever move was in there, it's going to come back to the VWAP because the volume weighted average price, which I normally show as, orange, that volume weighted average price, as it's starting to approach that last 30 minutes, these guys start getting out of that position and they're selling hard, and it takes it right back to the VWAP. Oh, that's a signal. Find the mover. The bigger the move up on a big fat index, the more likely it is to move as a VWAP magnet back to the VWAP. God damn it. Try yellow. That's what I want. The VWAP move in the last 30 minutes or the last hour, somewhere around here. This is when we do the VWAP magnet. Okay, so if all that is true, now what I have is in this normal time, I have 13 30-minute segments of normal, and there's about 2 hours of them. Let's see, 2.5 hours to lunch. And lunch has like 3 30-minute segments. And the afternoon has about 5. Yeah. So there's a 30-minute segment here and a 30-minute. So that's about 2 hours. Now, in that first normal segment, maybe you saw a move that was up like this. That's the size of the move. In the next 30 minutes, it will normally just it'll narrow. And then the last half of the day, it's either going to do continuation of the first move, or it's going to pull back halfway. So to me, a normal day sort of looks like on an up day, it might have moved this far, got into a sideways, and then from here, maybe if I take half of that, it's going to go halfway up or halfway down. So this could be a normal up day. It might have been opened here and closed here. And the way it got there was up, sideways, and back. And that was the path that it took. Or it might have come to here, in which case it would have gone up, sideways, and up. Or it might have just... So anywhere inside here would be sort of a normal day that started from here and ended up somewhere on that little continuum. And the same thing for a downside. So if you're trying to figure out which 30 or which 2-hour segment to do, I like this one because you get the biggest move of the day here, and then you get a follow through here. Now, I like either one of those. In the live trading workshop, we made a fortune just trading coming out of the lunchtime, and we could pick the ones that had the biggest moves, and then we could trade them in either direction. Hey, it might fail if we said, now here's the quietude of lunch, when everything, that's where the crocodile river happens. So if I said something like this, then I could trade a big move down, or I could trade the move that comes out of it. And then the least likely thing would be that that sideways quiet channel that happened at lunch would just continue to the end of the day. That would be very unusual for this thing to have a big move, find its perfect price at lunchtime, and then stay there the rest of the day. Could that happen? Sure it could. Happens in utilities, gold, silver, and commodities all the time because the commodities markets are closed. But I can get one half of the morning move in the afternoon move. And you get smaller risk boxes, and you don't expect a bigger move, and you can make bank in there. So if you want in my view, if you trade that after the first 30 minutes, you then trade the next couple hours, you have a chance to get the big moves that started right from the open, and you could set a trailing stop and just get whatever you get in the afternoon and just be happy with it. Or you could wait, you could study at lunchtime what the big moves were and then play for continuation pattern for a half size of that move in the afternoon, but before that last 30 minutes. You could do that. What I show in this video in about 12 minutes is how I break that up into those segments. And what kind of, I'm looking for some things early and then the morning and at lunch and the afternoon and the close, and I have a different mindset and different things that I'm checking in each of those areas. So that's a way that I organize the entire trading day by mentality. This video talks about how I routinely scan the daily report to find the symbols that are worth trading, which now gets to this question. How do I find the movers for tomorrow? Well, this is the systematic process I follow. The things that I look at in the market to see if the market is going to have a big day or which sectors are going to have a big day. I want to understand markets and sectors so that I can see if tomorrow is going to be a day when there's going to be more big movers no matter what. So you can actually pick the day that you want to do that on and be ready for the bigger days. And I consult that. I have a long video on how to do that in detail, reading the weekend report that's also on, that's in the course. So you can do that. And then specifically, I'm looking at each of the individual parts of the report, where I'm looking at the mechanical signals first. And then I'm looking at min pain and max pain and swing set. So I'm looking for mechanical signals, and this is like the auto framer and the regression line, the squeezes, and I put all that into something like a market mosaic to see which of the symbols in my normal population of trading, of which there are about 60, which ones are doing abnormally badly, because those are the ones that have crashed the hardest and are likely to make a big rebound or to just go to oblivion. Or I'm looking for the things that really stand out as abnormally good, because those could be continuation patterns or it could be a reversion to the mean. So I look for abnormal setup conditions, and then I frame for normal price action. And that's why I get so many 2-to-1s and fractional wins. So I look for abnormal conditions, and then I trade for normal behavior. And then if I get abnormal behavior, that's where I get those fat right tails. Check or hold. I've never said it that clearly or cleanly before, so that was pretty remarkable for me. So I could use something like this little worksheet, to say I'm always looking for these things from the market. These are all markets. The S&P, obviously, but the conservative U.S. large caps, the tech, the mids, the smalls, the Euro-Asia large caps, European, China, Latin America, Brazil. These things behave like big fat indexes, just like the S&P does. And these other assets are, so I'm always framing those no matter what. And I also frame all the sectors, because I want to know which sectors are in abnormal good or abnormal bad, and so I can exclude the stupid ones in the middle. And then these frog champions always move reliably large with minimal noise. You see me trading them all the time. And then very specific mechanical swing patterns. This predicts a mover, because 5 days down, and it has a 2-to-1 reward to risk ratio. That means tomorrow, if it opens inside the yellow zone and it starts to move, it's going to start moving like a swing trade for the next 3 to 5 days if it's going to be excellent, and it starts here. But if it fails, it's going to be a huge sell-off, because the previous move was a huge sell-off. So a 5-day down pattern is a predictor of a big move. That's how you find things that are more likely to move tomorrow, is look for the things that fire on the mechanical swings. And then the strategies are simply the things that I do, like I don't even have the sniper on there because this thing was built before the, but the goddamn sniper moves and frames. The Godzillas, holy smokes. Intraday, I'm looking for things like, if I'm looking at my standard normal where is it? Come on, dummy. 3-minute charts and 30-minute charts. I'm still watching. Hey, maybe maybe on the 1-minute chart, if I dial down, the 1-minute chart is going down. The RL10 on the 1-minute chart is going down, and the 3-minute is down, and the 10-minute down. Price just made an extreme move on all time frames. Then, if I see these two are still in the middle of a big down, And this thing was big down, but it has started an SSC. Maybe this is 3, 10, and 30 or something like that. Maybe there's an owl move on the 3. Now I can be alert to the possibility that that thing is going to be strong enough that the next higher time frame turns, and then the last time frame turns, and now all 3 of them are moving up. That's what the transition always looks like. It looks down, it goes sideways, it hints higher, and then it goes large. But it could also go down, it could also go down. So the turning points, those transition points, is where the MACD histogram goes from winter to spring, or from spring to summer, or from summer to fall, or from fall to winter. So these turning points allow you to predict or anticipate an increased percentage of a big move happening. That's all you need. That's all you can reasonably get, because everything looks the same leaving the station. The things that are false breakouts, whatever that means, it just means it only went that far and came back into the channel. It looks exactly the same as the thing that went all the way to glory. All of them were in a transitional state, and you can't tell from as they're leaving the state. They all look the same leaving the station. But if you started with the ones that are prone to big moves, like big gaps, mechanical swing, continuation pattern, frog champion, you get you that little set of symbols, those are the ones that are more likely to move large. Then all you got to do is monitor price action to see which ones are coming into the zone of transition. You can use MACD histogram for that. You can look at those great big turning points when the RL30 turns, and you get the owl entry. That's a good predictor of something that could make a big move, okay? So that's what I want to say about that. Here's another one. When it's sitting inside the Kata 2, the thing just made a significant move, whether you got it or not. Hopefully you got it. But the SSC worked. And you can see, if you didn't take it, in retrospect, you say, God damn it, I wish I had taken that trade. I should have taken that trade. Next time I'm going to take that trade. When you hear yourself saying that, you know that you have an unambiguous move, and then it's still short of the range stat. So now the thing rolls over, the dragon and the RL10 roll over, and it goes down far enough that maybe, just maybe, it only gives back 1/3 of this great big move, which was 3/3. It only gives back 1/3 of it. And you see the dragon turn and the RL10 turn, but before the peak of the RL10, let me put that in blue, before the peak of the RL10, now whether that's the dragon or the RL10, it doesn't matter. And now what you have is the pocket. Inside this, between the bottom of the dragon and the top of the dragon, or the RL10 and the RL10, you have a pocket entry. And that's what the Kata 2 is an entry before it breaks out, because this is the area where it is most likely to be hesitating. It's hesitating here until it gets a clear signal and a fresh new high of the day, and off it goes. But you have enough evidence that it turned that you're willing to take your tiny little risk box, and hopefully you'll see something beautiful occur, 1, 2, and beyond. So that, when you see that pattern, that is a predictor of things that have, it's a description of things that already moved, and it's a predictor of things that might move. And guess what? If that fails, what do we call that pattern? My favorite pattern.
Collapsing dragon.
Collapsing dragon all fucking day, all day. And even better is the one that's in the SSC, because it fails without ever having made a brilliant move. Like the harsh winter happened, it gets into the SSC. That's your best predictor if something magical is going to happen. And the best one is the collapsing dragon. That's a continuation pattern of the harsh winter to the downside. If you only traded one pattern in the rest of your life, you trade that one. But sometimes the SSC works, and you get COTA 2s forever and forever and forever, and you can get 6 or 7 of those, so you get a ton of frequency. They're not as impressive and massive as this, but you can get a lot of COTA 2s, and now you can refine your technique, and just taking bite-sized chunks out of the move up, there you go. So that's everything I got to say. We're 10 minutes past. I got to cancel this real quick, or end this real quick to get the recording going, and then fire it up for the creativity guys who are coming right after, and welcome to listen in. Okay. So, good job, good questions. I think I answered them all. And if I didn't answer, ask them again. I'll try to keep answering them. So there we go. And let's
Thanks,
see.
Ken.
Yep. End meeting for all.